Hey. Hi guys. Welcome to Macro Markets, where we analyze how the macroeconomic news and events impact the crypto space. I'm your host, Marcel Pechman, veteran stock markets and derivatives trader, analyst at Cointelegraph. On today's Macro Market show, we'll be debating whether US consumer debt has reached unsustainable levels and the risk of China manipulating its own foreign exchange rate. Today's show will start by discussing the US consumer debt. According to a Wall Street Journal headline, is it time to worry about consumer debt? What is going on? Consumers are still flush with cash, but are more often falling behind on some payments, making for a complex picture. So the first chart on the article is the credit card balances per quarter, and you can see that in the last recession in 2008, 2009, it went up from 0.75 trillion to 0.8, 0.9 trillion dollars. The same thing is happening right now as the US credit card balances surpassed $1 trillion. So there's a risk that some of those payments won't be made, so delinquency. The percentage of credit card auto loan balances transitioning into delinquency, that is, going from the current to becoming 30 days plus late, is happening at a faster pace than that of 2019. So here's the chart of US consumer balance moving to delinquent. The red line is the auto loan, which is increasing but not as we saw in 2009. Credit card also increasing at a fast pace but below the 2009 levels. Meanwhile, mortgage, the yellow line, and student loan at historical low levels. So the article goes on by saying, however, consumers aren't moving into financial distress at the same level they did when card and auto delinquencies were last occurring at those paces. So 2007, 2008. The number of consumers facing new foreclosures and bankruptcies is still at levels well below the pre-pandemic period. The key here, it seems, is that consumers built a cushion of extra cash savings as the government injected money to avoid a recession in 2021, besides the student loan that was forgiven over the last year. That explains why people are still able to pay for mortgage, but not some bills such as credit and auto loans. It is expected that the student loan debt payments will resume by October, and those represent 9.2% of all consumer debt, according to the Wall Street News. So here we have another chart by the Wall Street Journal, number of consumers with new foreclosures or bankruptcies. And you can see that both are well below the levels in 2007, 2008. So we still have some room for delinquencies here without being something major to the economy. So the big question is, how long can consumers sustain spending before their savings are depleted? Okay, so now we're gonna move to another article written on the Business Insider, whose title is Consumers Have Spent All of Their Excess Savings from the Pandemic. That's just one reason why stocks are poised to fall, JP Morgan says. A weakening consumer is just one reason why the stock market is poised to continue its decline, according to JP Morgan. In a Thursday note, the bank said consumers have spent down the entirety of their excess savings from the pandemic, which at one point totaled more than $2 trillion. My gosh, and what about liquidating assets such as their second or third home, stocks, or whatever they can dispose of? Well, the article kind of answers that. While there are still elevated levels of household liquidity across cash assets, estimated at $1.4 trillion when adjusted for inflation, that too is at risk of getting fully depleted by May 2024, JP Morgan estimates. I honestly don't know. If those predictions turn out to be correct and the savings are gone in less than 1 year, the stock market should have been much lower than it currently is. We are near the highest levels in 19 months, a mere 5-10% below. Either the market is turning a blind eye to the risk, or everyone knows a crash is coming, but they have nowhere else to park the cash. My honest opinion, I don't think that betting against the US stock market is a sound advice, given that inflation is right around the corner, meaning the government will be forced to inject liquidity, so more stimulus package to avoid a recession. So odds are there will be more money flowing into the market, and some of that will go to the stocks. Number go up, right? Partially, because the value of the US dollar itself will be going down. So hang on to scarce assets no matter what. Now let's move to China, where the central bank is struggling with its local currency. China's central bank steps up intervention after yuan hits 16-year low against the US dollar. Reuters reported that Chinese state banks were busy selling US dollars to buy yuan in an attempt to slow down the yuan's depreciation. The yuan, also known as RMB, is allowed to trade 2% above or below the fixing rate each trading day. Believe it or not, the exchange rates in China are set by the central bank daily. Incredible. No? Sure, they cannot yet force companies and investors to buy the local currency, but they might offer rates different from the market to curb the demand of the US dollars. Mizuho Bank wrote in a note that intervention risks for the onshore yuan is heightened as China's sputtering growth and financial risks undermining CNY stability. Okay, so why can't China simply decide, let's move the yuan from 720 to 650 or 6 per dollars? Well, for starters, that would be awful for exporters, as they would suddenly bring in less money. On the other hand, it would favor more imports, which is not exactly favorable for the domestic industry. But the biggest risk is the market doubting that in the country's ability to sustain a stronger yuan, meaning betting that the central bank reserves won't be enough to sustain the desired level. Once you get some billion-dollar hedge funds betting against your currency, things might escalate quickly. Sure, the central bank could simply block foreign exchange transactions and limit how many dollars a person or a company could buy each week or each month, but as history proves that nature finds a way. Meaning there's always going to be some entity willing to trade using physical gold, Bitcoin, or whatever means necessary to get money in and out of the country. In the end, this creates a parallel foreign exchange rate, which is par for the course in Argentina. Last I checked, the official rate was $1 for 350, 360 Argentine pesos. But if you go at any street exchange rate, you give $1, you get nearly 600 or more Argentine pesos. So there's the street rate and the official currency rate. In essence, what the Chinese central bank is doing in manipulating has its limits and ultimately has a risk. If investors start to lose confidence in the government's ability to keep the yuan strong, rest assured that those companies there will face serious problems to pay their debt in US dollars. And whoever depends on imports will also be at risk, further pressuring the Chinese economy. For now, there seems no imminent risk coming from the Chinese yuan, but it's worth keeping an eye on. Well, that's it for today. I hope you guys enjoyed the show. Remember to like and subscribe to the new Cointelegraph Markets and Research YouTube channel. See you!